Good morning, everyone, and welcome to today's webinar, International Commercial Terms. My name is Deep Sengupta, the founder of DSG Global, and we're delighted to have all of you on the call. The agenda for today, in a quick 60 minutes, is to provide a comprehensive orientation on international commercial terms. The agenda, as mentioned on the screen, we're going to start with what are international commercial terms? What is its scope? What does it cover? What does it not cover? We'll also talk about the different versions of Incoterms over the years and what's really changed in the current version of the Incoterms. We'll then go into the 4 different categories of Incoterms, such as the E group, the F group, the C group, and finally the D group of Incoterms. Finally, we will go into a quick quiz, and don't worry, nobody needs to answer any questions. I won't call on anyone, but it'll give you a chance to go through 5 different hypothetical situations using what you've learned about Incoterms today. So with that said, let's jump right into it. Now, Incoterms stands for the International Commercial Terms, and this is actually a copyrighted phrase that's owned by the International Chamber of Commerce based in France. The Incoterms was first established just before the Second World War, and imagine life at that time. There wasn't too much commerce over the air using airplanes. It was mostly ocean ships, and many of you might have even seen the Disney movie Beauty and the Beast. And you know what happened with the Beauty's father is, remember, he was a merchant, but he became a pauper overnight, most likely because he lost his ships at sea. My guess is he used the wrong Incoterms. So in 1936, when the Incoterms were first introduced, the idea was to determine the risks and responsibilities between the buyer and the seller throughout the sales process. Since then, Incoterms have been updated almost every 10 years on an average, where different countries have provided their input, their concerns, and the Incoterms have always evolved every 10 years to include technological improvements, regulatory changes, so on and so forth. So remember that Incoterms covers 3 main things. It covers the costs in the transaction. At every stage of the sale, it says who is responsible for paying for any particular activity and doing that activity. It also covers responsibilities and, most importantly, the risks in case of any loss or damage to the goods. Okay. This is exhaustive, not an exhaustive, but it looks a comprehensive list of the responsibilities between the buyer and the seller that an Incoterm would seek to impact. Number 1, the seller's obligation to place the goods at the disposal of the buyer. Where are they going to have it ready? In what form is it going to be ready? Who is responsible for packaging and marking? Who is responsible for export clearance, export reporting, export licenses? Who is responsible for buying the insurance to cover the products? Obviously, distribution of risk of loss or damage. Any documentation at any point, who is responsible for that? Inland as well as international transportation charges and other miscellaneous charges like import taxes, customs duties, brokerage fees, so on and so forth. It's also very important at this stage to talk about what Incoterms does not cover. Incoterms do not cover when the title transfers. And the International Chamber of Commerce, I'm going to refer to them as the ICC, they've taken a lot of pains to tell people, no, Incoterms does not cover when the title of the goods transfers. That should be dealt with in your sales contract. Similarly, if there's any breach of contract and consequences or exemptions from liability and all those other legal issues, the ICC has said, please incorporate that in your terms and conditions, in your sales order or purchase order. That is beyond the purview of Incoterms. In addition, revenue recognition, as many of you know, after Enron, where they started claiming revenue based on some amorphous projections in the future, and that's how they'd inflate their earnings for Wall Street. Incoterms has said that, don't use the Incoterms to decide when to recognize revenue, because that was not our intent. And just recently, the U.S. accounting boards, they've come out with some clarifications on revenue recognition, when you can claim revenue. So that's what should be the governing terms there, not Incoterms. Other contractual terms, such as breach of contract, all of this is beyond the scope of Incoterms. Now, I talked about the Incoterms changing almost every 10 years. And the current version of the Incoterms, which is called Incoterms 2010, was actually put into effect on the 1st of January 2011, which is more than 6 years ago. The big changes that happened from 2000 till 2010 or 2011 is a couple of things. Remember, we had the tragic incident of 9/11, the attacks. As a result, cargo security became a very important part of international trade. So that was one major development. Secondly, electronic transmission of records and reports to the government has started becoming a big thing. Back in the year 2000, you didn't have people getting on FedEx.com and printing their online airway bills, right? It came over the last 10 years plus. So the major changes that happened in this version of the Incoterms is, number one, they divided all the Incoterms into marine terms and omnimodal terms. Omnimodal means this term can be used for any mode of transportation: road, rail, ocean, air. Marine is obviously only an ocean term. And the reason they introduced this clarification is many companies that used to ship with an airline, either FedEx or DHL, they were using FOB, and FOB was designed as an ocean term, right? So to dispel this confusion, they just divided the omnimodal terms and the marine terms. Secondly, the Incoterms is really published in a book by the ICC, and this time around, which was 6 years ago, for these Incoterms 2010, they published a chart, a nice graphic chart of showing where the Incoterms govern each transaction. But they also brought out a very good book with useful guidance notes on each different Incoterms, listing out what's the responsibility of the buyer, what's the responsibility of the seller, made it very easy. Thirdly, they also mentioned that Incoterms can also be used for domestic transactions. That was another improvement, because we were seeing a lot of international trade blocks being introduced around the world, such as Mercosur in South America, the European Union prior to Brexit in Europe, which allowed for free movement of goods within Europe. So that's why the ICC said Incoterms is not just between borders, across borders, but also within a customs territory or a domestic shipment. Another aspect that the Incoterms tried to resolve this time around is to get more specific on the point or the exact place where a responsibility or a risk might transfer. In the past, you would be okay if you just said FOB Long Beach. But now the Incoterms want you not just to mention the place, but to mention the point within the place, such as the exact address at the Port of Long Beach or the exact address of your warehouse where the risk transfers. A couple of other small changes is in this version of Incoterms, they talked about cargo security information and who is responsible for submitting that to the government. We also included a provision for string sales, which is really a multi-layered sales transaction, where it's not just the buyer and the seller, it could be the buyer, it could be a middleman, and then the seller, and the Incoterms has been broadened to include this scenario as well. And then there's one aspect of container loading and unloading charges, which used to be almost, actually it's container unloading at the destination port. They used to charge both the buyer and the seller. There was some ambiguity. So this time around, container unloading charges has been excluded from the Incoterms, except for one Incoterm, which is delivered at terminal. So with that said, those are the major summary of changes. Earlier, which is the Incoterms 2000, which was in place from 2000 to 2011, there were 13 Incoterms, but the ICC looked at the terms which are used most, and they said, you know what? We need to delete delivered at frontier, delivered ex ship, delivered ex key, because these were hardly used. They had become antiquated. But then they also deleted the most popular term, which was delivered duty unpaid. And they started getting a lot of nasty comments from the importing community, but they explained that don't worry, the new code that we've introduced, which is DAP, or delivered at place, really covers not just DDU, but the other two terms that we deleted. And finally, they also introduced a new term which replaced delivered at key. Some people call it quay, but Singaporeans will tell you it's key. And they replaced it with delivered at terminal, because they realized that nowadays you have large shipping and airline terminals like the FedEx hub, and you also have large FTZ zones, and inbound transit. So delivered at terminal was more appropriate. So with that high-level overview, let's jump right into the Incoterms. Now, if there's one slide that I want you to take away, if there's only one slide, it would be this. Incoterms can be looked at in the form of a spectrum with, this is the seller's responsibility. At the very minimum, on the left-hand side, is the least responsibility for the seller. Imagine this guy is a lazy seller and he doesn't want to do anything, he or she, sorry. And those are group E terms, and with each term to the right, the seller's responsibility increases all the way till the D terms, D for delivered, where the seller's responsibility is the maximum and the buyer's responsibility is the minimum. The buyer in a foreign destination just has to open their doors and sign and receive the goods, right? That's a D term. So we're going to start with the E terms and inch slowly to the right so we can understand how the seller's responsibility gradually increases. And these are the different terms, E, F, C, and D. Now in an E term, remember the seller, it was on the extreme left, so they have the minimum responsibility. All they have to do is to make the goods available for the buyer to pick up at the seller's premises. It's called, there's only one term in this category, and it's called X works. And you can buy the book from the Incoterms 2010 book off the ICC website. It used to be about $75. And they list out all the risks and responsibilities very clearly. And I've tried to summarize it on this slide. So in X works, what the seller has to do is to make the goods available when promised, packaged, and ready for pickup. They also have to provide all the relevant documentation for the export, such as the commercial invoice, packing list, certificate of origin, or any other required documents. And the buyer, which is your customer, is responsible for everything else. They have to arrange for a carrier and transportation to pick up the goods and then to ship the goods internationally, and they have to pay for all charges, including customs brokerage at the foreign port, customs duties, what have you. Now, it is interesting that even though the Incoterm says that in this case, the customer or the buyer is responsible for export formalities, remember the United States has their own rules regarding export compliance, and they say the US principal party of interest or the foreign principal party of interest has to file the electronic export information, EEI, on ACE, right? So that's a slight exception where you, being the seller and the buyer, need to figure out who's going to file the EEI. It's usually the seller's responsibility in the United States, unless, of course, the foreign buyer agrees to submit it through their agent or freight forwarder, as the case may be. Now, the transfer of risk in this stage takes place as soon as the goods are put at the disposal of the buyer. That's it, and the seller can wash their hands off. And as I said, this term represents the minimum responsibility for the seller. It's all the way to the left. I've got these small computer cartoons, these graphics, showing that this Incoterm is applicable for all modes of transportation, road, rail, ocean, and air. So it's an omnimodal term. Moving slightly to the right is a Group F term. A Group F term, the buyer or the customer is still responsible for buying the main carriage and paying for the carrier, but the seller's job is to deliver the goods at the disposal of the carrier who's appointed by the buyer. So for instance, if a FedEx truck, if you're the seller and the FedEx truck pulls up into your dock location and you load the goods onto the FedEx truck, that is an F term. Alternatively, if the buyer says, you know, can you drop it off at my transportation carrier, which is 1 mile away, then that would be an F term, where you as the seller deliver the goods to the carrier appointed by the buyer. Now, there are 3 types of F terms. One is FCA, that's the only omnimodal term. And you have 2 other marine terms, which is FAS and FOB. So if you're shipping using a Air Express carrier, FedEx, UPS, DHL, and you're planning an F term, FCA is your only option. As we can see, FCA is just like X works with the additional responsibility on the seller to deliver the goods to the first carrier appointed by the buyer. They are also responsible for export clearance, and then the buyer takes care of everything else once their carrier receives the goods. And the transfer of risk shifts a little bit to the right. It takes place when the seller provides the goods to the carrier appointed by the buyer. The FOB is the most popular F term, mostly used by ocean liners. As you can see, it's a marine term. And back in the day, the rule with FOB was the moment the goods cross the ship's rail, the transfer of risk used to pass from the seller to the buyer. So imagine a crane picking up this container, and what if it fell? And if it fell on the other side of the ship's rail onto the ship, it's the customer's responsibility. But if it fell on the towards the port, it's the buyer's responsibility. So that was a little impractical. So this year they changed the term, the ship's rail, to say placed onto the ship. So once the container is placed onto the ship, then it becomes the risk transfers to the buyer. Again, it's like a typical F term where the seller arranges for delivery onto the ship, and the buyer takes care of everything else. I also want to say, in each of these terms, you can't just say X works or FOB. It's got to be the point and place that you need to mention as well, where you're making the delivery or the risk transfers. FAS is a case where, imagine a smaller ship moves along a larger ship and transfers the goods. This takes place in many developing countries or countries that have a very good marine network. It could be possible that a smaller ship containing produce, fruits, or bananas could move up along the bigger ship. So this is what the FAS term means. And similarly, when the goods are placed on the buyer designated ship is when the risk transfers. Everything else is standard with the F term. Now let's cross the border. We've talked about from the left the E terms, then we've gone a little more responsibility for the seller, and we've given them the responsibility of delivering the goods onto the carrier appointed by the buyer. But what happens in a C term is that the seller also pays for the international transportation. They contract for the carriage. But what's interesting is, although they pay for the transportation all the way across to the foreign port, their risk of loss is limited when they deliver the goods onto the carrier. And from that point on, the risk of loss or damage becomes the responsibility of the buyer. So imagine this, there are 2 points involved here. They are responsible for the cost of transportation all the way to the foreign port, but their risk of loss, the seller's risk of loss, ends when they deliver the goods to the carrier, which they are paying for. Very interesting. And many companies do this. Now, C terms are a little difficult to understand because there are 4 of them, so I've introduced this matrix. Imagine that there's rows and there's columns, right, in these 4 terms. Now, if you look at the columns, the first column says insurance mandatory on the seller. That means the seller is required to buy the insurance. And that's CIF and CIP terms. But there are two terms where insurance is not mandatory for the seller, and those are CFR and CPT. Now, if you look at the rows, there are two terms that are ocean terms only, and then there are two terms that are omnimodal. And the omnimodal terms, which is all modes, is CIP and CPT, and the ocean terms are CIF and CFR. So let's jump right into this. So except for those two variables, whether it's omnimodal or ocean, and whether or not insurance is mandatory or not, the terms are the same except for those different flavors. For instance, CFR, it's a marine term, and the seller is required to pay for the transportation to the final port. They obtain all the export licenses, export formalities, and CFR doesn't have I in it. That means insurance is not the responsibility of the seller, and the buyer pays for the insurance and pays for the transportation once the goods reach the final port. And they are responsible for custom brokerage, clearance, any import licenses and import duties at the destination port. And like I said, the transfer of risk actually passes much earlier in this life cycle when the goods are placed on board the ship. CPT is just like CFR, but it is omnimodal version. That's the only difference. So you can see it's suitable for all modes of transportation. Now, the marine version of a term where insurance is mandatory on the seller is CIF. It's just like CFR, except for the seller is required to buy insurance. Now, you know, it's very important to note that the seller is only required to buy the minimum insurance to cover the value of the goods. If you as a customer or a buyer want additional insurance, you have to take it on yourself as an additional cover. Okay, so remember that it's the seller's responsibility for insurance, but only the minimum insurance to cover the value of the goods. And the omnimodal version of this is CIP, where the seller is responsible for insurance and everything else is the same. Friends, now let's come to the term which imposes the maximum responsibility on the seller. It's the group of terms absolutely on the right of that spectrum, which is Group D terms, and there are three Group D terms. And in a nutshell, a Group D term says that the seller, the US seller, for instance, let's say they're shipping to Brazil, they bear all costs and risks needed to bring the goods to the final place of destination, which is Brazil. Now, the first term to cover here is the new term of delivered at terminal. And think of this like a FedEx hub or a foreign trade zone or a large, port of Sao Paulo in Brazil, for instance. And over here, the seller, obviously, he or she pays for all the transportation. In addition, they are required to pay the unloading charges, which I remember I said earlier was taken out of the Incoterms this time because there was a lot of double charging of this. But DAT, delivered at terminal, is the only Incoterm which assigns this responsibility to the seller. And the buyer is responsible for all import clearance and any subsequent delivery beyond that terminal to the final destination. And the transfer of risk takes place when the goods are delivered to the agreed place, which is that terminal. And this is an omnimodal term. Now, delivered at place, really you're delivering either at a place at the foreign destination or you're even delivering it at the doorstep of your customer. What you do not pay for is you are not paying for customs clearance, importing charges, and any other onward transportation after the goods have been delivered, right? And the risk, again, transfers at the point the goods are delivered to the agreed place. So imagine this new term of delivered at place is just like the old term, now deleted, of deliver duty unpaid, or DDU. So this is almost like DDP, which I'll cover next, minus paying for customs clearance and duties and taxes. And finally, the last Incoterm, which imposes the maximum responsibility on the seller and the minimum responsibility on your foreign buyer, which is deliver duty paid, where your goods are, delivered sealed to the customer's doorstep, and the seller takes care of all charges, all costs, all customs clearance, duties, and all the buyer needs to do is to make the goods ready for collection at their premises. And obviously, the goods, the risk transfers when the goods are placed at the disposal of the buyer. So friends, those were the four different Incoterms categories which cover 11 of the Incoterms. Let me now tell you about some common errors that I've seen in working with almost 1,000 customers of the various issues that they have. Number one, I just had a company, it's a household name, they make cell phones, and they just told me, hey Deep, we have this issue with our foreign terminal. Our goods landed in that terminal, but then it got lost in the terminal. What do we do? I mean, and I said, you know what? Your Incoterm did not say the exact place or the point. It only said the name of the foreign terminal. So technically, your goods have arrived and you are responsible. So, failure to state the exact address with specificity is a common error. Another point is many companies like to service their customers and provide goods DDP, which is deliver duty paid. But there might be some countries, Mexico above a certain threshold, Brazil, including India, which doesn't allow the customer to be the importer of record unless they have a license or they're registered or they have their own broker. So in some countries, DDP might not be an option. So always find out from your freight forwarder if DDP is permissible in that foreign destination. Another common error is with regards to export compliance. Now, many of you know that the Bureau of Census, which falls under the Commerce Department, is responsible for the foreign trade regulations. These cover the document which used to be known as Shipper's Export Declaration. Now it's known as the Electronic Export Information, which needs to be filed whenever your Schedule B value is more than $2,500, right? For any country other than Canada. So if you're shipping to a foreign party, there's always a lot of ambiguity on who is responsible for doing the export, electronic export information filing. If you just say, hey, it's just an X Works or a FCA term for us because they just picked it up from our dock location in Los Angeles, but you may still be the US principal party of interest if you know the goods are being exported. And, if the foreign party agrees to take on that responsibility specifically, then it's okay. Another thing that I've seen, a common mistake, is that, the purchase orders and the sales contracts don't reference the Incoterms often. It's just Incoterms are just mentioned on the commercial invoice. But including it in your sales contract, I think, is a very good way of doing it. Because as I mentioned in one of the early slides, there are many aspects of an international transaction that Incoterms do not cover, but instead the sales contract governs. So having the sales contract reference the Incoterm is always a good idea. I see so many companies do number 5. They ship ocean or they ship air, and they might be using a wrong mode Incoterm. For example, if they're using FedEx Express, which ships on air, but they're using a FOB term or a CIP term, so those are some common errors. And finally, a common error I also find is where companies don't really understand that customers or the buyers don't understand that even though they select a CIF or CIP term, which includes mandatory insurance for the seller is only responsible to cover the minimum value of insurance. So that's another common error. Friends, with that, I think let's jump in to our pop quiz. So the way this works is I'll go over a fact pattern, and after the fact pattern, I'll give you all a few minutes to think about the answer. And if you want to type in the answer in the chat box, you're welcome. And then in a couple of seconds, I'll give you the answer with my explanation. And we have about 5 different fact patterns. So let's get started. So this is scenario 1. A satellite antenna systems manufacturer located in South Korea. They sell the goods on consignment to a large, major US-based telecommunications company. Now, the US company doesn't want to bear any cost or responsibility for the shipment and wants it delivered to their door. Consequently, the South Korean company bears all costs to ship this to the US distribution center. What is the applicable Incoterm? I'll give you a few minutes and then I'll give you the answer. Friends, the answer is DDP. Imagine this Incoterm was the extreme right of that spectrum, where the seller does everything and the buyer does nothing. So it's deliver, duty paid. The second scenario is a mobile communications manufacturer in the USA imports aftermarket parts from contract manufacturers in Mexico. The contract manufacturer pays for the carriage across the border, but they want the US buyer to arrange for customs clearance and payment of any customs duties. What is the applicable Incoterm? I'll just give you a few minutes. So the answer here is delivered at place, or DAP. It's almost like DDP, except that the contract manufacturer from Mexico doesn't want to take care of customs duties and customs clearance. So it's very similar to the former Incoterm of deliver duty unpaid, which is now known as delivered at place. Scenario 3. A large exploration supplies company based in Houston, Texas, sells equipment for oil and gas exploration to major firms around the world. Now, the small parts are shipped by UPS bill shipper with the declared value. Large shipments also build shipper, but are sent on the ocean mode using UPS as a freight forwarder. On these ocean shipments, the buyer requires that the seller obtain marine insurance. So what is the applicable Incoterm for these large shipments? Remember, it's ocean mode and the buyer requires marine insurance and the shipper is paying for the transportation. I'll give you a few minutes. Friends, the answer here is because it's CIF. The reason it's CIF is because the supplier, the shipper, is paying for international transportation. So that's, a C term. In addition, they require marine insurance, which is either CIP or CIF. But because this is an ocean mode only, the correct answer is CIF. Scenario 4. A cellular infrastructure company in India sells cellular tower equipment to major firms worldwide. These towers are broken down into smaller components and shipped in a container with a steamship line arranged for by the US buyer. The Indian seller agrees to arrange domestic delivery and place the container on board the ship, but refuses to bear any responsibility beyond that point. What is the applicable Incoterm? I'll give you a few minutes. Friends, what we have here is that there's a foreign company. They're shipping their goods on a ship, so it's an ocean mode, and they're arranging for domestic delivery where they're going to put the goods on board the ship or the first carrier, but no more responsibility after that. So this is a classic F term, and it's ocean mode, so the answer is FOB, whichever port in India they ship from. And finally, scenario 5. A US-based defense contractors representatives travel to Germany to evaluate a manufacturer of communication processor chipsets. Now, when they're there, they're really impressed with the product, and they decide to purchase some chipsets right there and ship these back to the US company after purchase. They use their own DHL account number and they drop off the shipment at the DHL drop box in the supplier's facility. What is the applicable Incoterm? So these US employees are overseas. They buy a product overseas and they ship it from that overseas destination right from the supplier's facility because there's a DHL drop box there. Well, the answer is X works because this is the seller's minimum responsibility, and the buyer, who actually happens to be right there at the dock, decides to ship it right from the dock and take delivery and ship it using their DHL account number. So it's classic X works. Friends, at this time, I'm delighted to take any questions. And if you have any confidential fact patterns that you are not comfortable discussing today, feel free to send me an email anytime or drop me a line, call me. I'm delighted to discuss your Incoterm questions with you. And also, if you'd like to understand which is the best Incoterm you should be using for your business operations, I'll be thrilled to help. No questions at this time, so I will assume I did a good job and clarified most of your concerns. Please stay in touch, and once again, thank you for attending today's webinar from DSG Global on Incoterms. I wish you all a fabulous day, and thank you.